Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and today is December 9th, 2023, and our model portfolio is up year to date 13.87%. We have a green for the stock market strength color signal, and we do a simple portfolio here with only 3 positions. We either have the ETF shares SPY, which represents the S&P 500, or we do options, or we are in cash. Here's our investment allocation breakdown right here so you can see that 100%. Here are some past returns for the model portfolio for the past 3 years. We've done really well. Last week, the S&P 500 gained 0.24%. And here we are right here, and you can see that we are in this current trading range right here. There was very small advancement over the last week's trading. Here in the thumbnail, you can see how well the S&P 500 has done over the past 1, 2, 3, 4, 5, 6 weeks in a row with green candlesticks. Last week, we made no trades. Here are some of the trades we've made in 2023, the most recent trades. We have two current open positions. We have 200 shares of SPY, and we're profitable in that position by $3,400. And we also have 2 call options in the money covered calls with the strike price of $4.25. So we're fairly deep in the money. And we're currently taking a loss on our covered call positions because we had to roll them out. So we have to add these 2 positions together. And here is our model portfolio equity curve for year-to-date 2023. And here is the equity curve of the S&P 500 buy and hold investor year-to-date 2023. And here are the 2 equity curves combined so we can compare our model portfolio against the benchmark of the buy and hold investor. And you can see how the 2 portfolios have fared. Now, we did fairly well up until this point here, and at that point, I took a more conservative approach, whereas the S&P 500 has just gone up. Now, each one of these round sections here is a week. So we've gone up for 1, 2, 3, 4, 5, 6 weeks in a row for the S&P 500. If you go back and you look at 2023, the biggest advance they had was here, 1, 2, 3, 4, 5 weeks in a row. So by any normal measurement, this is an extremely extended rally. We should at least get 1 week of negative increases in the S&P 500 before more advancement, even in a strong bull market. Here is the Fed Chair, Jerome Powell. The next interest rate announcement is next week, December 13th. What is he going to do? Is he going to give us the 25 basis point rate hike or a skip? We shall see. Now we're looking at things from the presidential election cycle theory. President Biden is in his 3rd year. Historically, for the S&P 500, that averages 16.3%. And for the NASDAQ 100, symbol QQQ, that would equal normally 32%. For the S&P 500, is currently up 20.26%. Historically, in the 3rd year of a presidential cycle, it is 16%. So we're 4% fat according to historical averages. All right, now we're looking at things from the bond market. We still have the nasty inverted yield curve. 10-year yields, 4.18. 3-month yields, 5.25. This is backwards. So that is not good for equity investors. Now we're looking at things from a valuation standpoint, according to 2 different sources. We're looking at the source CMV, current market valuation. They say we're overvalued. We are overvalued by 52.9% above the modern average for the PE ratio, which puts us at 1.3 standard deviations. In addition to that, we are also, according to VectorVest, for the symbol SPY, the S&P 500, we're currently at value. The current value is at 460, and we're at the current value. The current price and value, I'm sorry, are equal. So they're saying that the market is priced accordingly. It's like they always say that anyways, no matter where the market is. Anyways, they currently have a buy recommendation. Overall rating is good. Upside potential, fair. Now we're looking at CNN Business Fear and Greed Index. Here's our friend Warren Buffett, the Oracle of Omaha, and pretty much the same as last week. We're still at greed. Last week 67, this week 68. Now we're looking at things from a seasonality outlook. This is the month of December. Normally, going back 20 years for the month of December, there's a 70% probability you're going to close the month higher. For the current month, we are up 0.83% for the month of December. Now, historically, the S&P 500 averages anywhere, depending upon how far of duration you go back, anywhere from 7.52 or 7.51 to 10%. The market is up 20%. So we're fat according to historical averages of what the average return is for the S&P 500. So by all means, this market has been in a very, very strong market. A lot of it due to last month's action. Now we're looking at things from a long-term outlook. This is a monthly chart for the S&P 500 going back 20 years. And we're in a long-term bull market. We're still in this bull market as long as we stay above three things. This line here, and as long as the MACD stays positive. The MACD is positive. All of these things are positive. This is bullish from a long-term outlook. Now we're looking at things from an intermediate term outlook. We're looking at a weekly chart, candlesticks, 5 years of data. Here in the thumbnail, you can see those 1, 2, 3, 4, 5, 6 weeks of all green candles, not one red candle in 6 weeks. The probabilities speak very largely that the next candle or the one after that is going to be red. Now, how much of a red, I don't know. But you would think you would get some red just from an historical basis in all markets. I mean, here he had a really long, good run, but there was one red candle right there in between. That was with 1, 2, 3, 4, 5, 6 weeks. And then that next one was red, and then we advanced some more. Are we here? Or are we here? It's very difficult to gauge this, but we have not reached this high that we made in 2022. And we're in this trading range right here that I've got the two lines drawn, this red line and then the all-time high right here. So we're just in this range here. It looks like we're stalling out. Now this is for a short-term outlook. 6 months daily chart, S&P 500, see the nice advancement, and then we've moved sideways. Now the last candlestick right here, you can see this is Friday's candlestick. Well, Friday's candlestick just broke out above that range that we were in. And interestingly enough, it broke out on volume. And the slow stochastics went positive, and the MACD, although below its signal line, has definitely curled up, and the histogram suggests that if we stay up here, that is going to pull in and go positive. The problem is the level of the MACD. The MACD is at 6.018. Okay, now we're looking at the same chart, which is the S&P 500 daily chart, but instead of going back just 1 year, we're going back 5 years of data. Actually, this is the same chart I showed you last week to show you how elevated the MACD is. And when all these lines here, these vertical lines, when they intersect this horizontal line, which is at the current level of the MACD, topping out, this is where you've seen corrections more times than not. There was not much of a correction here, but more times than not, shortly after we reached this level of the MACD or higher on a daily chart, we're going to have a pullback. The probabilities are high, that a pullback is in your future. Now we're looking at the risk-on indicator, which is a ratio chart of the NASDAQ 100 compared to the S&P 500. When this chart goes up, the NASDAQ is outperforming the S&P 500, and it also is that's a risk-on indicator telling you that investors are putting money into the market. So the S&P 500 still advances as well, even though the NASDAQ 100 is outperforming. So generally speaking, it's a bullish indicator for the stock market in general. It looks like we've reached a level of support on the ratio chart here, and we're heading north. Although it did begin to lose momentum, it looks positive. Now the MACD it's below its signal line, but the histogram is suggesting that it wants to curl up and go above it. Slow stochastics has already broken above its signal line. So all of these things here are suggesting that it's a bullish indicator that market risk is on right now. Now we're looking at another ratio chart of the equally weighted S&P 500 to the normally cap-weighted S&P 500. This is all suggesting that we're bullish as well. The ratio chart is way down low, and it is heading north. And normally when it does this, we get some sideways action. This is a weekly chart, so you normally get weeks of this back and forth action. So I wouldn't be surprised if this just toggles up and down for a few months before advancing and staying advanced, giving us that nice bull run that we're looking for. The blue line is the S&P 500. So right now it is looking bullish, though, from everything that we're seeing. Until this comes down, so far all signs are green. Now we're looking at the VIX Volatility Index, also known as the Fear Index. We are in the ultra low range, which is bullish. MACD is positive, and slow stochastics, although topped and head below its signal line, is just curled above 20. So this is all bullish. The MACD, which is above its signal line, looks like it's topping and getting ready to come back down. What I'm seeing here is telling me we're going to spend more time in this low range. The more time you spend in the low range, it's actually bullish for stocks. So I'm suggesting that this chart is telling me that the market is bullish. Now we're looking at the Thinkorswim platform with standard deviations. Here's information about standard deviations: +2, -2 in gold, +1, -1 in pink. Regression line is the dashed green line. Currently, you can see that we, on the 1-year chart, are right here, and we're at 0.3 standard deviations. I drew in that a recent all-time high at 721, and you can see that top there, and we've just actually breached that top. Now we're looking at the same chart, but instead of going back 1 year, we're only going back 6 months. On the 6-month chart for the S&P 500, we are at the 1.9 standard deviation right here on this candle. I've got this cell box here so that you can see that I'm saying that this is a sell zone, because normally speaking, 95% probability you're going to bounce off of the +2 standard deviation and head south. Like here, you didn't even reach it, you headed south. Here you're at the +1, headed south. Here you're below the regression line, headed south. But then when you get below or near the -2, that's your buy zone. I've put the buy zone up here because the market is acting so strong. I got a feeling that we're not going to be spending much time below the regression line. So I think anywhere in closing this gap here would be a buy zone. Ideally, I'd like to buy it right here where there was a previous top reached before heading south. I've got an alert here at 436.96 on SPY, and that would be an ideal time to take and close out my in-the-money covered calls and put on some long calls right there, see if this market holds, and then find some legs and continues in advance. Now we are looking at the stock market strength based on asset classes and the 11 S&P sectors. So I got the S&P 500 here as a whole, But I've broken down the 11 sectors here so we can see the strength of each market sector. The S&P 500 is telling me that we have a strength, an asset class strength of 4. Now the chart can go from 0 to 6, 6 being the highest. And here's how I get all of the information right here. So we're at 4, which is a bullish indication. Remember, normally the market, the S&P 500 goes up 75% of the time. It's heading higher rather than lower. 75% of the time. You got to remember that. It's just that you would ideally not like to be caught in that 25% correction time. That's what we're trying to avoid, and that's why we're not buy and hold investors. That's why we're traders, because we're trying to get ourselves out of that market. But this top section here is all different asset classes. So this kind of gives you a strength of how the world is looking over different indexes and different asset classes. Well, the world is looking fairly good. Right now it's at 63%, and last week it's at 58%. Anything over 61 and over gives you a green signal. Well, we've got a green light here for all asset classes in general, with the weakest class being silver. Now, on the 11 S&P 500 sectors, we are currently at 75%. It got truncated. Last week, we were at 65%. Not sure why this got truncated with the green, but I know that was 65% last week. So we went up 10%. So the market sectors are getting stronger. And so we have a green signal here as well. Now we are looking at a chart it's a 1-year chart of the 10-year bond yields. That is the candlesticks. Now the blue line is the S&P 500. You'll notice that when the 10-year bond yields are heading down, the S&P 500 is heading north. Well, look what just happened. And it just found support at a previous level that was resistance. So it bounced off of this 41 level and just started to head north. The MACD is way undervalued here at this green line. In 2023, going back 1 year actually, you don't even see a touch where the MACD was this low, except for just from last week's action. We've curled, bounced, and it looks like we're heading north. Well, if this bond yield is going to head north and go anywhere near this section here, well, the S&P 500 is going to no longer be heading north. It's going to be heading south. I have just given you a ton of information in this video. Now comes the critical thinking. What are you going to do with the information? This is what I am going to do. December 9th, 2023, market summation. According to me, your friendly host, Ken, with SPY Trader Now. I am still holding my in-the-money covered calls, but I'm only making pennies while the market is making dollars, because I'm only getting time decay value with an in-the-money covered call, and I'm losing money actually, because as the market goes up, my in-the-money call, instead of becoming less profitable, is becoming more profitable, which is not good if I want to close the position. The advantage of my position is that if the market does correct, which I still expect it to, I'll be making dollars while the market is losing dollars, because my in-the-money covered call is going to be losing money rapidly. So I can close that out, hopefully for somewhere around break even, ideally. So here, what are my options? What am I going to do? These are the options that I have. I can, number one, stay the course. Number two, I can sell my poor performing in-the-money covered calls. Number three, I can keep my current positions and add some long calls going out over a year, which will give me some time if the market does pull back, and then take advantage of being long. The only drawback with that strategy is that if the market does pull back such as I expect it to, my long calls are going to immediately start to lose money, which the number one goal of this game is to not lose money. My fourth option, I could just use some of my cash and I could buy some more SPY shares. That would be a non-leveraged position that I could take on, giving me some opportunity to take advantage of going long if the market is going to continue to advance. To me, the sum of the evidence says that the odds favor a pullback with little room for higher levels over the short term. We will go with option 1 and we're going to stay the course. We do want to go long in this market, but we don't want to enter more longs at this level. Pretty much regurgitating to what I said last week. My plan is to buy to close my in-the-money covered call positions when SPY reaches some level of support. I'm looking for that pullback. I'm still looking for the pullback, folks. We're in a good position. We're holding $17,272 in cash in the model portfolio. And we are up 13.87% year to date. So that ain't nothing. That is a reasonable return, far surpassing money market or CDs. So we are still making money in this market. We're just not accomplishing my goal. My personal goal is to beat the returns of the S&P 500 buy and hold investor. I don't believe we're going to accomplish that goal in 2023. I severely doubt it the way things are. We're too close to the end of the year. So, but still, almost a 14% return for 1 year is nothing to sneeze at all. So, all good. I hope you've gotten something valuable out of this video. Please hit that like button for me right now if you have gotten any value out of this video at all. Hit that subscribe button, ring that bell. I thank you and I wish you good trading.